Hey, Inspired Moneymaker. Today's guest loves stock investing and says owning high-quality companies is a powerful way to compound your money. Episode 233 features Brian Feroldi, investor, financial educator, and author.
That's what I'm after as an investor, is companies that can substantially grow their revenue and profits over long periods of time. It's that revenue and profit growth that impacts what happens to a stock price over long periods of time. If you bought a company today that 20x its revenue over the next 10 years, the odds are very, very good that you're going to have a very positive outcome with that stock, even if you paid a high price to get in on day one.
I'm Andy Wong, host of the Inspired Money podcast and financial advisor at Runnymede Capital Management. This episode is brought to you by Yachty.com. My friend Everald Reed launched Yachty to showcase Jamaica's best products and local vendors. With just a couple mouse clicks, I can treat myself to authentic Jamaican Blue Mountain coffee. We love it at our house. It's balanced, full-bodied, but without the bitterness. I also love the breadfruit chips and natural bar soaps. It's great knowing that every purchase at Yachty.com directly supports local Jamaican small businesses. You've got to try Blue Mountain Coffee for yourself. Go to Yachty.com, that's YAAHDY.com, and make sure to use coupon code MONEY for 10% off your entire order. Try it and let me know what you think. Now on to the show. Our guest is Brian Feroldi. He's a financial independence guy who's on a mission to spread financial wellness. As an investor, he's been honing his stock picking strategy since 2004. He's written more than 3,000 articles for the Motley Fool, posts videos on YouTube, and has a new book entitled, Why Does the Stock Market Go Up? In this episode, you'll learn why you might consider picking your own stocks over only investing in index funds, the difference between investing and gambling, and tune into the end to hear what Brian thinks about real estate investing and cryptocurrencies. Now let's get inspired with Brian Feroldi. Brian, welcome to Inspired Money. I'm so excited to have you on the show.
Andy, pumped to be here. Thanks for having me.
Let's jump right in. What's your earliest childhood memory of money?
Well, like many kids or many families in the United States, money was a relatively taboo subject in my household. So it wasn't something that we discussed openly with each other. In fact, I remember sitting at the dining room table, and one time my dad told me how much money he made, and the next word out of his mouth was, "Don't tell anybody," right? Don't tell any of your friends. So like many people, I just grew up to like not ask about it. But my parents were good with money, and they practiced good financial habits. I know that they were savers, and they paid off their mortgage early, and they didn't buy fancy, flashy things. I mean, every time we went on vacation, we would always be making sandwiches and bringing them for lunch with us, right? We never ate out when we were doing things like that. But my first memory of money itself is probably when I would be taken to the bank and I had a passbook account. So each of us had our own savings accounts, and whenever we got money for our birthdays or from our grandparents, we would go there and deposit it. And one of the exciting things about doing that in the 80s and 90s is banks used to actually pay interest back in those days. That was a sizable number, and you had no clue. Like, there was no way to check your balance online. So the only way that we could check our balance was when we actually went to the bank and made a deposit and got like an update about our like running interest total. So I vividly remember seeing, I had a few $100s in there, and I was like, whoa, I made $7 for free in interest. So that's one of my earliest memories.
It's so old school because you were physically holding a passbook and you got interest, which is a very foreign idea today.
Yes, right? I know. We haven't had that in 12 years, 13 years?
Yeah, and I don't know when that will, that pendulum will swing. We'll see what happens. There's so many scenarios that we can think about, like what the world will look like and how do you get off of a zero interest rate policy. I think we don't really know. Like,
for sure.
Is there a precedent for that? I don't think so.
Not that I'm aware of, but yeah, that's something that will sort itself out. I mean, inflation is pretty high right now, so I have a feeling interest rates are going to be coming back, but definitely not to the rate of the 5, 6% that they were that you could just get in a bank account in the 90s. So yeah.
Well, I'm excited to have you on the show, and I'm kind of curious to hear as we hear your story how you transitioned from growing up in a household that don't talk about money, don't tell anyone what I make, to being a content creator, a writer. You have a big Twitter account, big YouTube account. You're a writer at Motley Fool. You're such a student of investing and financial markets. How did that actually begin?
Well, I knew nothing about investing growing up. My dad did own some stocks, but he himself dabbled in like penny stocks. So I did get a tiny taste of what it was like to quote unquote invest in the market because he would own these stocks and I would watch their share price go up and down. And he was into penny stocks back in the day, which is how I first started investing. But my interest in investing in the stock market really didn't happen until after college. And by the way, I say that as a business major myself. So I went through all of college and I don't ever remember talking about investing or the stock market or any of those things that are just so foundational to building wealth. None of that was really discussed, even though I was a business major. But what really started the love affair that I had with investing was when I graduated college. My dad handed me a copy of a book very popular at the time called Rich Dad Poor Dad by Robert Kiyosaki. And that book, while I now think it has many flaws to it, it was the first time that a book opened up my eyes to some very important concepts about money, namely the rich think about money differently and are taught the money principles that are different from the middle class and from the poor class. You are in business for yourself, whether you know it or not. Everybody is in business for themselves. We just don't think of it that way. You can become wealthy in one generation. The rich use their money to buy assets, and those assets either produce income or increase their wealth, and everyone else just spends their money on frivolous things and doodads, as he calls them. Those are really important concepts that I had never heard or never really explained to me before. So it really opened my eyes for the first time about the concept that if I just save my money and invest it well, I could actually become wealthy in one generation. And from there, for whatever reason, those principles just immediately took hold, and I just fell in love with the concept of saving, personal finance, and investing. And I just started to voraciously read every book about money and investing that I could get my hand on. That gradually led me to read books by the Motley Fool. David and Tom Gardner have several books out there. That led me to visit their website, fool.com. That led me to start investing according to the principles that they had. And then about 7 years ago, because I'd spent so much of my time on the Motley Fool's website, I started to become a writer for them, and I made that into my career, and that was 7 years ago.
That's really cool. A lot of people have read and been inspired by that book. What do you think? Like, was there a moment that sparked this insatiable curiosity? Because not everybody reads the book. Like, they get the ideas, but I think many people don't just keep reading and like try to build and grow their knowledge.
Yeah, I don't know what it was about it. I think that I am just have a natural disposition for the concepts and for money in general. I mean, I've always been I'm a natural saver. I've always been good about making money and then not spending it. I'm not someone that's really driven by consumerism or fancy clothes or anything like that. So I just think some people have savings built into their genes, and I'm just one of those people. And for whatever reason, the topic of money and investing just grabbed me the same way that some people are really into fashion or they're really into like a sport and they just know everything about that sport. For whatever reason, the thing that I'm just really passionate about is money and investing.
Yeah, you are certainly a like diehard personal finance guy. Talk a little bit about, because I understand that you and your wife saved like 50% of your income for a long time. So this journey of financial independence, retire early, do you aspire to officially retire someday? Or do do you subscribe to finding something that you enjoy that never feels like work, that you can just keep doing?
Yeah, when I first came across the concept of FIRE, financial independence, retire early, I was just like, this is what I've been doing. I just didn't know it had a name. Like, again, both my wife and I are natural savers. And before we had kids, we lived very, very modestly, essentially the same way we did that we were in college, but our incomes increased as our career increased. And before we had kids, because we were living cheaply, it wasn't that hard for us to save a sizable portion of our income and turn that into investments. And that just so happened to coincide with the time period when the Great Recession was happening and stock prices were plunging everywhere. So neither of us, thankfully, lost our jobs. So we kept on saving and investing throughout that entire period. And that time, that proved to be a very wise thing to do in time after stock prices rebounded. But I used to believe that I was after financial independence and retire early. The idea of I could just stop working altogether really, really appealed to me. But the more I studied financial independence and retire early, and the more people I've talked to that have actually done it, most people aren't really interested in retire early. What they're really interested in is financial independence. And now, both my wife and I really enjoy our careers. Like we just like getting up and doing what we're doing. It's how we are actually choosing to spend our time. So we're no longer chasing retire early, but we are still pursuing financial independence as fast as we can.
As good savers, what do you see as the end game? Are you saving for a rainy day? Are you saving for this financial independence so that you're not beholden to a company? Like, what is the goal?
Yeah, it's the latter. It's to have a big enough nest egg so that we can work. There might come a day when either of us wakes up and we're just like, I don't want to do this anymore. And when you're in that position, it's very common for people to feel that way, but they're trapped in their lifestyle, right? They've grown accustomed to living the good life, and they have no choice but to continue working their job so that they can pull in the income so that they can feed their lifestyle. Both of us are very happy doing so, and we don't really have an end game other than continue to save, continue to invest, and keep doing what we're doing. So that it is such a funny question, right? Like, you're doing all this work. What's the point of what are you trying to do with the capital? And we don't have a good answer right now other than to say that capital will be there to support us in case we decide to make different lifestyle changes. Like, there's nothing that we're like jonesing to buy at this point. We feel like we have like enough. So it is an interesting philosophical question. Once you have kind of like enough, what is the thing that drives you to continue to want more? I don't have a good answer for that.
Yeah, it's a moving target, I feel like. And sometimes maybe the answer is just flexibility, because then you have choices and maybe your goals change, because at one moment it could be that you want to travel in retirement. That's way down the road. And then it can just be about like passing it on. It's like legacy. It's leaving it for your kids, or being able to help your kids if they needed it. So yeah, lots of choices.
Both my wife and I were lucky enough to have parents that covered our college costs. So we both graduated debt free. That's definitely a gift that we want to pass on to our kids. But on the flip side, I'm also ascribing to the plan that you don't want to leave your kids such a big nest egg that they don't have to do anything, right? That robs them of their ambition to go out and make something of themselves. But I also plan on living to at least 100 years old and having a good lifestyle. So I plan on using the money that I have now to fund the rest of my life.
Good goal. And if you're going to live to 100, health costs could be very, very expensive. So
Sure,
keep
sure could.
keep saving.
Yep.
So let's talk a little bit about investing. There are so many ways to invest successfully. And I think that you, like me, see benefits of passive index investing and stock picking. And I don't think that that has to be a total contradiction. Can you talk about that?
Yeah, this is something that a lot of people is a hotly debated topic, especially for people that have financial independence. There are people that point out that have been trained, most mutual funds lose to the stock market index over time, which is 100% true, and you have to pay a huge fee for doing so. Therefore, the only logical way to invest is with index funds, dollar cost average into index fund. It's the tried and true method, and doing so keeps your costs low, keeps your taxes low, and is the most efficient way to invest. I agree with all that. I agree with 100% of that. However, I actually firmly believe that the reason that most mutual fund managers lose to the stock market index over time isn't because the managers themselves aren't smart or aren't driven, but it's just the structure of the money, the way that money is managed, that makes them, that handicaps them to essentially be makes it so much harder for them to outperform the market over time, simply because their focus, when your job is managing money for other people, your focus is on gathering assets. That's how you make more money. Your focus isn't necessarily on beating the market. And even if you want to think long term, even if that's your mindset and you want to buy and hold good companies for long periods of time, that only matters if you can communicate that and get your clients on board with that plan, which is so much harder to do than you would think otherwise. Because of that, I'm a believer that if the topic of picking your own individual stocks interests you and you have the time and inclination to do so, that can be a viable strategy for someone to do. And that's exactly what I do with my own capital. All my retirement funds are just indexed for sheer simplicity, right? I have regular contributions to 401k, we have IRAs, all that's just indexed, so I don't have to like think about it, and it's all dollar cost average. But any capital beyond that, it's in my my taxable brokerage account. 100% of that is invested into individual companies that I have hand selected. So I don't think it's necessarily an either or thing. I think that there's room for both, but it totally depends on the person and whether or not they want to spend the time learning how to pick and invest in stocks. For a lot of people, that time is just not worth it to them.
Right. So then it's better just to own the entire market and not worry about individual companies.
Mm-hmm.
So I've heard you say that like one of your biggest edges as an investor is that time horizon. And you feel like mutual fund managers or active, even hedge fund managers are kind of handicapped by that. Can you contrast that advantage that you have?
Yeah, it's so crazy that me as an individual investor who has less information, less access, slower computers than professionals would have any advantage over them at all, right? It's just so crazy to think that that could be the case. However, I, as an individual investor, have one advantage over them, and it's a massive advantage, and that is I am managing my own capital. I am my own client. I'm never going to fire myself or have to worry about convincing myself that I'm the right person to manage my capital. That's not the same case for people that are managing other people's money. So because I'm managing my own capital, I can actually think and act, importantly, act with a long-term time horizon. So whenever I'm going and making an investment in a company, I'm asking myself, could I see this company being substantially bigger, substantially more profitable 5 and 10 years from now than it is today? And I can truly say, if I believe the answer is yes, I don't really care what happens to the stock price over any given quarter or month or week. In professional investors often can't make that same trade-off because they have to report their results and report their holdings to clients. And no matter how much training you do with clients about think long-term, act long-term, clients don't like it when you hand them papers that have big red numbers on that. I mean, case in point today, the poster child for this right now is Kathy Wood. Kathy Wood, I think, is a great investor. I really like the way that she invests and the way that she thinks. But her fund has been extremely volatile. 2020 was a huge year up. 2021 and 2022 have been huge years down. And you see the heat that she's taking in the news from her investors and from the media, calling out that her style doesn't work, and she's gone through this extreme drawdowns and all that kind of stuff. Can you imagine what it must feel like to be her? right? She believes in these companies and she believes in her investment for the long term, but she has these huge reported losses that she has to report to investors. She's not unique in that regard. That's the exact same thing that everybody goes through that has to manage somebody else's money. They have to explain losses to their clients, and they have to tell them it's okay, it's going to be fine, prices will rebound. That's a really hard thing to do, because saying to a client, here's the expected volatility, and then that client actually feeling that volatility are two entirely different things. So again, because I'm managing my own money and I've set my personal finances up to be able to withstand huge volatility, I don't have to make those same decisions. So I can truly think and invest for the long term, which is unique.
Yeah, having that patience and true long-term view and holding period, I think is easier said than done. But in my experience as a financial advisor, I've seen clients who grew their wealth in like a very big way. I've also seen investors who did well over time. And some of my favorite stories are like the individuals who didn't have huge incomes, but they always invested consistently, and that compounding grew. Oftentimes they never sold. Like, sure, there were companies that went bankrupt and disappeared or got delisted, but they just stuck with an approach. And usually they were trying to stick to like blue chip names, like recognizable names, solid companies. And over time, I mean, the appreciation was incredible. And yeah, time horizon was clearly a part of that. They weren't disturbing their investments in the near term.
And what you just said is really important, because when you invest in an index fund, the only thing that you see with that index fund is the price of the entire fund. But if you crack open any index fund, what's happening on the inside is chaos. I mean, just utter chaos, right? There is a sizable amount of the companies that are in there that will fall drastically and they'll stay down forever. Some of the companies that are in there will roughly match the performance of the index, maybe a little better or a little worse, but they'll roughly hug the index. But a small minority of companies, somewhere between 7 and 10% of the companies in that index, literally will account for 90% plus percent of the gains of the index. So it's a minority of companies that account for the vast majority, if not all, of the gains of the index. That's blinded to you if you're investing in an index fund, because you're guaranteed to hold all the winners as well as all the losers. But if you're buying individual stocks, you often see that dynamic playing out in your portfolio. Looking back at my own investing history, about half the stocks that I buy, despite doing lots of research on them and buying them, holding them for long periods of time, I'm going to lose money on. Like that's just how it works. Some of the stocks that I buy will do about as well as the market. However, just a handful of companies that I own and have bought have done so well. They've just so dramatically outperformed the market that they drive the returns of my entire portfolio. If you didn't know that that's how it works ahead of time, how could you not be frustrated and confused that everything that you're buying isn't going up? But that's just how the stock market works.
So talk a little bit about what that looks like. Say if you had and I'm talking percentages. So if you had 10 individual stocks in your portfolio, what does that, I guess, attribution look like if it matches the index? And what does it look like if you're beating the index?
Yeah, so I've since I've been tracking my results, which have been about 9 years. I changed my investing brokers about 9 years ago, so that makes tracking beyond that a little bit tricky. But I've beaten the S&P 500 over the last years by a few hundred percent. So for me, the effort that I've gone to pick and build this portfolio has paid off. However, when you're doing something different than the index, that means you're going to get different results than the index over shorter periods of time. And my portfolio has been under huge pressure over the last year because my style of investing, which is primarily to invest in high growth, low risk businesses, that has been out of favor with the markets over the last year or so. So I've actually dramatically underperformed the index. So again, if I had to explain my results to somebody else, boy, would I have a hard time doing so. But when I zoom out and I look at the longer term results, which is what I'm focused on, I'm quite happy with how things have performed. But broadly speaking, my investing style is I've created a checklist for myself that I use to screen the market or companies for criteria that I think matters the most to me, and then I run companies through that process, and then I try and buy the companies that are a best match for my investing style. I ignore the ones that are not a match for my investing style, and then I hold them voraciously, knowing that going in, I'm going to be wrong often, but I only need to be really, really right on occasion to do well.
Uh, when you're doing when you do screening, are you using tools at Motley Fool? What do you use to do that?
So I built my own investing checklist that I use. So it's just a Google sheet that I've made, and what I did was I made two lists for myself. The first list was all of the attributes in a business that I personally am attracted to. So that is things like a very strong balance sheet, high returns on capital, profits, a competitive advantage, optionality, low customer acquisition costs, recurring revenue, pricing power, a founder-led management team, et cetera, et cetera. There's literally like 20, 25 things that I look for in a business that really attract me as an investor. Conversely, I made another list, which is all of the things that I don't want to see in a potential investment. For me, that's things like customer concentration. I don't like it when a company gets a sizable amount of its revenue from just a handful of customers. I don't like it when there's problems with accounting. I don't like it when that company has underperformed the index since it came public. I don't like it when a company buys growth, so it's acquiring other companies to grow as opposed to growing organically, et cetera, et cetera. So I made these two lists, one things that are attractive to me, one things that are not attractive to me. And then I forced myself to rank them by most important to least important on both accounts. Once I had both of those ranked lists, I weighed them according to a scoring system that I fixed at 100. So I gave myself 100 points, and I said, dole these out based on the attributes that are most important to you. And doing so really forces you to make some hard decisions about what is actually important to you versus what is not. So I've created this checklist that I have, and now I can take any stock that I come across and put it through this checklist top to bottom. And the number that comes out the bottom is essentially a quality score that indicates how closely this company matches what I'm looking for in an investment versus all the other companies that I've done this to. And I've done this now hundreds of times, so I have a good list of companies that are the closest match to what I'm looking for in an investment, as well as a list of companies that I will never be interested in. From there, I continually buy the companies that score the best on my investing checklist while simultaneously factoring in the companies that are trading at the most attractive valuations at any given time. And then I just repeat that process again and again and again and again. And I think that the long-term results, if I continue to do this, will be favorable.
Brian, I think there are probably a lot of people listening and watching whose heads are spinning after hearing you talk about your spreadsheet. And it makes me think that you probably are a bit of an outlier because the average person doesn't have that interest or curiosity to go that deep. I was kind of surprised, like over the pandemic, I was chatting with a good friend, and she was very fortunate to received some money from her mom. Her mom gave her some cash and said, I want you to invest this money for your future. And she had never bought a stock before. So take a step back, because I know that you did mention the penny stocks. It sounds like you have a very diverse experience in buying a stock and then deciding what kind of stocks you want to own and developing this approach. Like, talk a little bit to somebody who hasn't really bought a stock before. Where do they begin? Because it sounds like you've both made successful investments, but you've also learned expensive lessons too along the way.
Yeah, so the process I just described is what I've been refining now for essentially 18 years. So don't think that like I created this 18 years ago and I've been doing it ever since. No, I was a terrible investor in air quotes 18 years when I first started. I had no clue how to research a company, and the stocks that I was buying solely based on their share price. End of research, right? It was like, does this stock trade below $5 a share? I'm interested. that was it. So predictably, because that was my research, right? Share price. I did terribly. I bought garbage companies that then went on to deliver poor results to me, their investor, and I did bad. But I deserved to do bad because I was buying. I wasn't investing. I was gambling. I was betting that the stock price would go up over a period of days or at most weeks, and that I could sell at a higher price. So I was trying to trade penny stocks, which is just a loser's game,
You
in
mentioned
my
that your
opinion.
dad kind of did that too. Is
Yep.
that
Yep.
something that you had, like, did you learn from your dad and you could
Yes.
chat about that?
So sort of. He would again, you have to run the clock like 20 years ago. How would you even find investing ideas, right? You would read about them in the newspaper, and maybe you would get a ticker and the dollar price of a stock. Like doing research 20 years ago, 20 plus years ago, was so much harder than it is today. I mean, we're so spoiled to have the internet available to us, and companies put out links to their SEC filings and presentations and conference calls. Like the amount of information that we now have to make investing decisions is so much improved from what it was 20 years ago. But yeah, I was investing in some of the stocks that he was initially. And then at the time I was using Yahoo. Yahoo had a free stock screening tool. And again, my criteria was share price. So that was the only thing that I was using to make decisions. And predictably, I did really, really poorly. So I've gotten better at investing and figuring out how to invest and how to read things like SEC filings and think through investor presentations and moats and competitive advantages, all because of trial and error. And most helpfully, I've had direct relationships with a lot of other investors because of the Motley Fool's investing platform that has just helped me tremendously. One thing that's wonderful about the Motley Fool is they have these, once you become a paying member, is they have these discussion boards behind the scenes where people can share research with each other and openly. And it's just amazing the collection of investors that go to that site and just freely share their information and their experience. And it's just spending hundreds or maybe even thousands of hours interacting with other people on those discussion boards that I learned so much about what I know about investing today.
So you feel it's very important to have this community of like-minded investors that you can engage with.
Oh, very much so. There's investing is a hard endeavor, and it's so much harder when you're on your own. But if you can find a community of like-minded people that are there to help each other and share research with each other, it just makes investing so much easier. Especially because if you can find long-term oriented people that can hold your hand at least mentally when things are not going your way, it just makes such a big difference.
Yeah, so you mentioned Kathy Wood, and I think that her big thing is like, how do you identify, or she's trying to identify mega trends, so that it's like momentum and mega trends so that you can be investing in the next Google or next Microsoft. How important is that in your view as an investor? I mean, I think to me, it seems that's very important. When you can identify Microsoft when it's baby Microsoft and is going to be growing for 20 years, that's where you make real money.
Oh, absolutely. And I think that right now we're living through one of the most innovative and disruptive periods in history. I think that the 2020s are going to be unbelievably disruptive to almost every industry on Earth. So whenever a disruption comes along, society as a whole tends to improve. But when that happens, there are winners and there are losers. Like there's no doubt about that. History is very clear on that fact. So when I'm trying to identify a company that I'm interested in investing in, one of the key things that I want to ask myself is, could I see this company if it executes against its game plan? Could I see this company's revenue being substantially higher than it is today, and the same for its margins and its profitabilities? That's what I'm after as an investor, is companies that can substantially grow their revenue and profits over long periods of time. The reason is it's that revenue and profit growth that impacts what happens to a stock price over long periods of time. If you bought a company today that 20x its revenue over the next 10 years, the odds are very, very good that you're going to have a very positive outcome with that stock, even if you paid a high price to get in on day one. Conversely, If you find a company that is trading at a very cheap price today, but that company is heading towards bankruptcy, it doesn't matter how low of a price you pay for that stock today, you're going to do very poorly as an investor if you hold that company. So yeah, when I'm looking for companies, one of the ways that you can come up with ideas is thinking about some mega trends that are existing, and then thinking through who are the major players in there and what are the ways that they could benefit. So that's absolutely a factor in how I think about investing.
How do you look at, or how do you apply valuation to different stages of a company's growth? Because I think if you're looking for a major disruptor in the early stages, it may have no earnings,
Mhm.
and that's going to look very different from a more mature company.
Totally. And this is the one of the most hard things that I've ever had to wrap my head around as an investor. As I mentioned up front, I'm a natural saver, right? I'm built into my bones is paying as little as possible for things and extracting as much value as I can about them. So when I first discovered Warren Buffett, Charlie Munger, Benjamin Graham, Seth Klarman, those are famous value investors, and they say things like price is what you pay, value is what you get. All intelligent investing is value investing. And what I always took that to mean is, well, I'm trying to find a company that's worth $1, and I'm only going to invest if that company is trading at 70 cents or 60 cents, right? That's what I'm trying to do. I'm trying to find low valuation stocks. Someone that changed my mind so completely on that very fact is David Gardner, who's one of the co-founders of the Motley Fool. If you look at his track record, he called so many stocks that have gone to home run early: Amazon, Netflix, Tesla, Pixar, etc. These companies that he bought very, very early, and they've literally delivered 10,000+% returns for investors. And what he discovered through his investing is, if you pick the right company that is really destined for growth, you should almost hold your nose when it comes to valuation, and you should be very willing to pay very high valuations for companies, because if those companies do go on to fulfill their destiny or their promise, the high valuation that you pay will still look very, very small in hindsight. So that's something that's very hard for me. That was a very hard concept for me to grasp as an investor. One quick story about that. In 2006, the company I was working for signed on with a brand new startup software company called Salesforce.com. And I loved the software. I immediately saw the value of Salesforce.com's software to us as the company. I was like, this software is incredible. It's so powerful. Well, I checked, and Salesforce.com was a publicly traded company at the time. And I looked it up, and I was like, I love this software. The PE ratio is 100. 100. Pass. I can't buy Salesforce.com. Its PE ratio is 100, right? There's no value investor on earth would say that's a good price. Well, you can probably guess what's happened next. Salesforce has grown and grown and grown, and is now a multi-$100 billion company. And if I bought when the price was 100 times earnings, I would be up at least 20-fold on my investing. And why? Because Salesforce turned out to be a phenomenal company and a phenomenal investment. So even if I paid a super high price valuation up front, I still would have done very, very, very well. So that's why valuation can be so tricky, and why I've learned to actually devalue valuation on my investing criteria. I still always look at it, but I've learned the hard way that if you like everything about the company except the valuation, you should probably still buy a little bit.
Valuation is very tricky, and I think that even many analysts, it's their job to study and understand the companies and to know the industry. Oftentimes, it's hard for them too. And then the challenge is that great companies can be overvalued for a very, very long time, and you can't really tell when that changes sometimes.
Yep.
But yes, on the other hand, it can be a good way to control some of your risk, right? You don't want to like pay any price. You're trying to buy something reasonably. So yes, that one's a tricky one.
Very hard. Yeah. One thing that I currently do is rather than focusing on the valuation, I try and focus on the market capitalization of a company. So market capitalization is just the current share price times the number of shares outstanding, and it gives you a dollar figure for the total amount of the equity value of that company. So if I find a company that's trading under, say, $10 billion in today's market, that's not that big of a company. I ask myself, if this company is successful and executes, could I see the market cap being 5x or 10x where it is today? If the answer is yes, and I like the business, I'm just going to buy a little bit of the stock. I'm not even going to look at the valuation. Conversely, if I find a company that's over $100 billion, that's really successful, its growth has really started to slow. So that's a company like Apple or Google or Facebook, some of the mega caps that are out there. I'm going to be much more focused on valuation for those companies because their future potential is so much lower on a percentage basis than it is when they were smaller. So I think of valuation as a sliding scale. The higher the potential, the less I value it. The lower the potential, the more I value it.
Makes sense. So that you have a numerical sort of relative comparison to see where is it on its path to growth. Like, is it mature or is it still early and has a lot of room to grow? What are areas of potential disruption that you're paying attention to today?
So there's many out there. One thing that I like to think through, it's a good thought exercise for you, is just because a technology comes along that disrupts us and changes our lives doesn't necessarily mean that that technology field is going to deliver benefits to their shareholders. One quick example of that, if you look over the last 20 years, what's happened to solar panels, right? The solar industry. I mean, the growth has been unbelievable, right? The number of solar panels that are available today is dwarfs what was available 20 years ago, and I'm almost 100% positive that that will be the case even more so 10 and 20 years from now than it is today. However, if you look at the historic returns of solar panel manufacturers, the companies that are actually making the solar panels, they've been terrible in investments, and you're like, how could that be? That this industry has grown so rapidly. How can the companies that make the solar panels have done so well? The reason is as they get better and better at making solar panels, they have to pass on those price gains to customers in order to entice them to continue growing. I mean, everyone knows that the price of solar panels, like most technology, is just falling, falling, falling. So all of the benefits, all of the value that's being created from the solar panel industry isn't being captured by the solar panel manufacturers. It's being captured by society and solar panel buyers. Because of that reason, I'm not all that interested in investing in solar panels, even though I still think the industry has tremendous growth. Conversely, one of the trends that I am heavily invested in is the software industry. Over the last 20 years, we've seen lots of companies in the software industries transition their business model from licensing model, where you buy software and then you buy a new disk in 1 to 3 years, transition away from that towards a software as a service business model. So that takes a one-time lumpy sales pattern and it turns it into a smooth, predictable, recurring revenue pattern. That's very highly attractive to me as an investor because that business model works out so well. So because of that, when I'm thinking about allocating capital, I would much rather buy a company that was focused on software as a service than I would that's focused on the solar industry.
Yes, I love software as a service. They have visibility, they have a stickiness with their clients, and that the recurring revenue is powerful.
Yes.
Talk a little bit about the importance of managing your behavior as an investor in bad times.
Yeah. So that's one of the tricky things about investing. It doesn't matter how good of an investor you are, what kind of decisions you making up front, how much work you do. All of that is useless if your behavior is wrong. And we are just so programmed naturally to be terrible investors, right? We are naturally want to be with the herd. So when stock prices are rising and everyone's excited, we have a huge natural instinct to want to buy and get in on that. And when stock prices are falling and everybody's pessimistic, we have a natural instinct to want to sell and be filled with fear. And it's very easy to tell yourself, I'm not going to act like that. It's an entirely different thing to actually act that way. So because of that, because stocks are volatile, and if you're buying individual stocks, they're even more volatile than the overall market. I've taken steps to protect myself financially so that I'm able to withstand huge amounts of volatility. So what I do is with my personal finances, I am hyper conservative, hyper conservative. I have no debt of any kind. I keep a big cash balance for my personals, and we have a high savings rate. We have multiple sources of income. I've done everything I can to make my personal finances as bulletproof as possible. Because of that, whenever the economy goes through a rough patch, or even during things like COVID and stock prices are plunging, I have zero need to ever sell my stocks or ever bail out of stocks to fund my lifestyle, because my lifestyle and my personal finances are so conservative. Because of that, that affords me the luxury of being able to withstand huge amounts of volatility within my investing portfolio. So financially, I can withstand it, but I've also done a lot of work mentally to just understand and study how stock history actually works. And again, through repetition, through connecting with other investors, and over time, you just get more and more battle torn in your head so that you can deal with the volatility. But if your behavior is wrong, it doesn't matter how good of an investor you are, your returns are going to be terrible.
On the investment portfolio side, do you maintain some cash for rainy day or like dry powder?
Yeah, my personal my cash portfolio in my investing portfolio, exclusive of my emergency fund just for a living expenses, hovers between 0.5% and 10%, depending on current market prices and what kind of opportunities that I can find in the market. So I do keep a little bit of dry powder on the side. And when stock prices are very high, I tend to be less enthusiastic about buying. And when they're low, I tend to be more enthusiastic about buying. But I'm not saying that that's actually the right thing to do. Studies actually show the best thing to do with your investing capital is to invest it all, 100% of it, all the time, and just keep it in the market and going. But I do like to keep a little bit of cash on the sidelines to take advantage of bargains that I see.
So is the mindset in a bear market, do you just have to remind yourself that you have this 5-year, 10-year horizon and you can afford just not to pay attention to it? Like, don't look at it right now because you know that it's a temporary situation where the market is in a downturn. Talk a little bit about like what your personal investing experience was like during the dot-com crash. I know that goes back really far, but even like the financial crisis back in 2008.
Yeah, the financial crisis, 2008, was really interesting training, mental training for me at the time, because I was investing a decent amount of money. And at the time, I was mostly in mutual funds. But it didn't matter what you were buying in 2007 and 2008. Whatever you bought was going down. I mean, it
Only
was going
cash.
down
Only
very
cash
hard,
held up.
right?
Yeah.
Exactly. So I vividly remember buying and investing my normal allotment of capital, and then literally within a matter of hours or days, I would be down 5%, 10%, 20%, and then I would make another investment and I would go down again, and I'd make another investment and it'd go down again. It was brutal, right? It just felt awful. Every time you were buying, you were just instantaneously losing money. That's a really hard thing to do, and for you to accept. But to answer your question, nowadays, when my portfolio is down, as it is right now, I just look at my holdings and I ask myself, do I still believe in this company? And if I'm ever questioning why did I make this investment, I just pull up the company's most recent earnings report. Right. And I look through the financial results that the companies that I have are reporting. In almost every case, the financial results that the companies that I own are reporting look really good. Revenue is up, customers is up, margins are improving. Not in every case, of course, but if the company itself is improving, I'm going to continue to hold the stock because I know that the stock price will eventually reflect the reality of the business. What you see in bear markets is prices and fundamentals just get completely detached from each other on the downside. The same way they just get completely detached from each other on the upside. In 2020, everything was going up. Didn't matter if the business was struggling or growing fast or not. Over the last year, we've seen the exact opposite, where it doesn't matter what you do. If you're a high growth stock, your stock is going down. That's just how the market works, and you have to be willing to accept that if you're going to buy individual stocks.
So it's really about knowing yourself and knowing your investment approach. Because once you're developing that, and of course it's always evolving, but you want to stick to it. You want some level of consistency.
Oh, completely. The name of the game with building wealth is compound interest, right? Compound interest is everything, right? The longer you invest and the longer that compounding happens, the higher your total is going to be. So what's the key to making sure you can compound for as long as possible? Longevity. Sticking with something for as long as possible, regardless of what's happening in the market. That's why I've focused so heavily on making my personal finances so conservative, because I know doing so gives me the flexibility to think long term and truly act with a long term behavior. That's what I need to do for my personality to focus on the long term. But everybody has different risk tolerances and what they're willing to put up with.
Super valuable. As a student of personal finance, and since we started the conversation with Rich Dad Poor Dad, what are your views on like stock market, which obviously you have intense interest in, and this investing has a very critical role, an important role in your long-term financial goals. Where does real estate fit in, other asset classes?
So I've looked at real estate. I've checked out buying laundromats. I've checked out buying multifamily units. So I think that real estate, small businesses are an excellent place to look for investors that have that kind of personality. But based on personality, I just know myself. And if I ever had to deal with throwing a tenant out of a house or any of the real downsides, the bad parts about coming with real estate, I wouldn't sleep. I would feel awful, right? I would be so forgiving of tenants to be like, of course you can stay as long as you want to. Don't worry about paying the rent. Like, that's my personality. So I know that me, as a human being, would just be a terrible landlord from thinking about a return on investment perspective. For that reason, I don't invest in real estate beyond a few REITs that I own, because I've discovered that my personality is a best fit for publicly traded equities. But I think that people that focus on real estate, or again small businesses or any other asset class, totally makes sense if your personality can handle it.
And getting back to disruption again, what are your views on blockchain, cryptocurrency, and Web3?
So a few years ago, a lot of my friends, especially my coworkers, know that I'm interested in stocks and investing. And I got like so many text messages, and I don't even remember what year, maybe like 2017, about like, what do you think about Ethereum? What do you think about Bitcoin? What do you think about blockchain? And I'd heard of it at that point, and I knew more about it than they did. But my broad advice was, I don't know. There's no cash flow. There will never be cash flow. I have no idea how to value it. For that reason, it sounds like gold, right? It's just going to based on the enthusiasm of the market. And for that reason, I've taken a pass on it. More recently, as I've learned about it more, and it's become more clear that huge amounts of humanity believe in it, I've changed my tune a little bit, and I actually own a tiny little bit of Bitcoin and Ethereum today. The reason that I changed my mind is I just asked myself a very simple question, which was, should there be a digital currency of the world? Like, should there be a digital currency of the internet? I think the answer is yes, right? I just think the answer is yes. Right now, the leading contender for that thing is Bitcoin. So I could see it becoming more popular over time. And that's especially true when you think about what's happening with currencies around the world. And living in the United States, I've never had to deal with a huge currency devaluation or a run on the bank or anything like that. But those are very common things that people think about in other parts of the world.
Those are
And
real
for that,
problems.
right? Those are things that I've never had to concern myself with. But in other countries, the volatility of Bitcoin is nothing compared to the volatility of their own currency and the risk that they take on by owning their own currency. So when you think about it from that perspective, it's like this actually has a utility that could be valuable to people. So because of that, I own a little bit of a Bitcoin and Ethereum. I could see myself investing more. I'll never make it. I have no plans to ever make it a large part of my investing portfolio, but I see nothing wrong with devoting a small part of your portfolio to it.
Makes sense. And then on the stock side, you could invest in companies that are benefiting by cryptocurrency. So something like Nvidia with the graphic chips, or even like an exchange like Coinbase. You could take a look at the earnings and try to understand how the company makes money, which is a little bit more tangible than just looking at a digital commodity, if you make that analogy. So
obviously, the upside won't be as high if those currencies work out. But even companies like MasterCard, for example, are experimenting with ways to make their networks better by using blockchain technology. So sure, I think the fundamental technology, blockchain, is very interesting, is very disruptive. I'm not sure I can pick which cryptocurrency is going to be the big winner, but right now it looks like blockchain and Ethereum are two of the better bets.
yeah, Bitcoin.
Bitcoin.
So Brian, I like to ask all the Inspired Money guests, how do you define success?
Yeah, my definition of success has definitely changed a lot. My current definition of success is waking up and being able to do what I want with who I want for as long as I want. And I am complete control of all the terms, and I can quit at any time with no changes to my family's lifestyle. So that to me would be the best definition of success that I've come across so far.
Sounds like a very broad definition of financial independence.
Yeah, basically. You could also just shortcut it to financial independence.
Yeah. Well, thank you for sharing your passion for investing with us, telling your personal story and giving some tips on how people should view their investments in sort of different ways, different lenses to look at their investments. Tell everyone where they can follow you and follow more, because as I mentioned earlier, you do have a sizable following and growing even still.
Yeah, the place that's the easiest to connect with me is on Twitter. I'm at Brian Feroldi, and I'm spending an increasing amount of my time on YouTube these days, where we have a channel where we show people how we go through in my investing checklist and how to review earnings and things like that. So if individual stock investing interests you, you can check me out on my YouTube channel, which is my name, Brian Feroldi.
Thank you so much, Brian. So what was your favorite Inspired Money moment? I've met many professional investors who live and breathe stock analysis and investing. I think Brian ranks right up there. He has a real passion for research and stock selection over the long term. I like what Brian said about investing according to your personality. For him, real estate is not the right fit. Being a good investor not only requires focus, attention, and good research, but it helps a lot to know yourself and what best suits you. Think about your money and investing personality. See what investment approach and asset classes are a good fit for you. If you had a different favorite Inspired Money moment, post a comment here or in the Inspired Money Makers Facebook group at inspiredmoney.fm/Facebook. Thanks for tuning in to the end. I want to invite you to subscribe to my email that goes out every 2 weeks. The Runnymede investment team, that includes yours truly, shares data, news, and events that we're looking at. Subscribe by going to inspiredmoney.fm/newsletter. It has a double your money back guarantee. That's because it's free. Thank you for joining me on this mission. Have an inspired week and do something that scares you, because that's where the magic happens.